Hello, everyone. Welcome back to Venture Wisdom, the place where we talk everything venture capital and private equity. I'm your host, Rakesh Bhatia, and today we are here to discuss the nuances of structuring the fund for the first time. So, largely focused on the early and the emerging managers. And to discuss that, we have with us Yoni Tuchman. Yoni is a lawyer for about 20 years now, a fund attorney for over a decade. He studied law at Columbia Law School and is a partner at the DLA Piper's fund practice and is based in LA. So thank you so much, Yoni. I appreciate your time to talk with our audience today.
I'm excited, Rakesh. Thank you for having me on.
So, Yoni, we'll be talking about the nuances of forming a fund for the first time. But before we jump into the conversation, I would love to hear more about what you do at DLA Piper, a little more about what the fund practice at DLA Piper does.
Oh, that's great. Thank you. So your intro is spot on. I can't believe how fast time is flying, but I've been doing this. It's shocking for me to hear this come out of my mouth, but for 20 years, forming funds. From my earliest day as a little baby lawyer in Manhattan, the firm I was at put me into fund formation. I don't know what my good fortune was that they decided I was going to be a fund formation lawyer. I didn't know what a fund was in 2004 when I started that job. But it was serendipity or fate because I love what I do, and I'm very thankful for that first law firm, Dewey Ballantine, back in the day. We at DLA Piper, I've been here for 5 years. I came in COVID. Fantastic move for me. DLA Piper is a massive law firm, but that's not, to me, what's so great about it. It's the people and the warmth here. We are a super friendly bunch. I think we self-select for that. And humbly, I would say really good at what we do. So in terms of the fund formation, we form all kinds of funds, open-ended, closed-ended, registered, not registered. But for me personally, I form closed-ended, for the most part, private, unregistered funds. So a lot of venture capital, a lot of growth equity, lower middle market, PE, real estate, credit, and a smattering of fund of funds. A fund is a fund. If you've seen one, you've almost seen them all. Now, there's a lot of nuances that distinguish, for example, a venture fund from a buyout fund or from a real estate fund or from a credit fund or a fund of fund. But the better you know funds, the more you'll recognize that they all have so much more in common than they have different, right? I work a lot with emerging managers, a lot. Why? Because in LA, on the West Coast, there's a lot of that going on. There's a lot of foment over, people leaving firms, whether it's PE or having been investors as venture capitalists and now forming their own firm. The folks who are hungry and ambitious and not tied to a historical relationship are the folks I'm going to say, let's do this together. Hop on my back. I'm going to carry you to closing. And that's kind of how we roll. So excited to have this conversation with you because it's a passion. I'm a bit of a nerd that way. It's a passion. I love this stuff.
I hear that excitement. And when you said in all humility that you guys are doing a good job, believe me that I have heard people who are working with you talking great about how you work and how fun it is while doing that serious job of making the fund when they are working with you. So congratulations on that.
Thank you.
I would say.
I'll say, just to throw out, I did not to. I know we want to talk shop. We want to talk nuts and bolts of funds. But I would say I'm glad you heard that. If a client doesn't love their lawyer and their team they're working with, then something's wrong. It needs to be a relationship of like excitement mutually.
Jumping into the subject, as I said, our audience for today's conversation is largely the emerging GPs. So we are talking more from the structuring because I think the guys who have already lived that life, they know how to structure it already.
Right. Right.
Although there may be some differences as they grow in their lives, the number of funds, the size of the fund, and so on. But if we start very basic, what is it that they should expect before they jump into the waters?
Here's how I strongly recommend an emerging manager to approach the question, Rakesh, that you just asked. It's a process, and the process needs to be very clear up front. Because otherwise, I imagine an emerging manager kind of like the blind man, like feeling his way through the dark. Not only can't you see, but it's also dark around you and other people can't help you, right? You don't know what you're going to stumble into or poke
Yeah.
yourself into. You need to have someone who's like, look, let's demystify this for you. It's not rocket science. Here's what it's going to look like. You know that proverbial advisor who's going to look around the corner, tell you what's coming after you make the turn? It's really very simple to form a firm, honestly, if you've done it many times. Here's how I'd answer that question. Number one, I would say change your glasses a bit. You're not engaging in fund formation if you're an emerging manager. And I've written about this a bit in the past as well on social media. You're engaged in firm formation for your first fund, right? Because a fund formation means I have all the superstructure. I have a management company. I know how I'm employing people. I know where the carry's going or where the management fee is going. I know what my Advisors Act regulatory overlay is, and I need to form a fund. That's okay for fund two, even. Certainly for fund nine. But for fund one, you're really starting with a blank sheet of paper. You're not forming a fund, you're forming a constellation of entities to support that one fund that you're looking to form, but that will also then support fund two, fund three, SPV, co-investment, extension fund, all of the things you're going to be doing over the course of building this firm, this empire, if that's the vision. So we start with a very simple, rudimentary structure chart. Okay. Here's what you need to do. You need to figure out the structure of the firm, including the fund, but not limited to the fund, right? Because again, there's a number of entities that we're going to be talking about. Get a structure chart down. 90% of that, if not more, is tax driven. It's not terms driven. It's not securities law driven. It's not regulatory driven. 90+% of that is tax driven. That's part one of scoping out what this firm looks like. Structure of all the entities. Step two is, okay, let's focus on this fund. What does this fund look like? What are the terms of this fund? That's really important. You're designing this fund so you can then build it and close it, sell it, right? Those are the two key elements of the answer to your question. How do you start? Design both the structure and design thoughtfully the terms of the fund. Have in mind that when you're designing fund one, including the terms, unless like, I don't think any clients that I have are like this, where they're like, okay, I'm just doing one fund, then I'm going to retire, right? The goal is form fund one as a stepping stone to more and even larger funds. So keep in mind that what you're designing for fund one is going to be the blueprint for fund two, and therefore fund three and fund four. That's not to say that you can't change terms, that you can't recalibrate structures and terms as you progress from fund one to fund two and so on. But the core elements are going to be the same unless you affirmatively decide to change or to pivot a little bit. And you have to keep in mind that any investors in fund one who are going to re-up in fund two will then be aware of those changes. So be thoughtful from day one. So you're designing a product and a fund that can sustain you past fund one, bearing in mind that you can always change and likely will on the margins, but keep that kind of long view in your head. We can
And,
get
and,
into those
and
topics.
Yeah, no,
however
I'm
is
glad you
best.
brought that point because I think I would have, if you had not brought it up, I would have brought it up any which ways. But I would still get into a little more details as we further move in the conversation. That is around the flexibility. Okay, you're creating that blueprint as you're talking about, right? But then that not necessarily may remain a constant as you progress into the fund two, fund three, fund four, or number of funds, or maybe even from the point of view of what geographies you want to invest versus how you want to look at the taxation, where the LPs are coming from, and so on.
Right.
So we'll get into that in a little moment. But then, since you started with the point of the first piece of the structuring and putting that structure chart, right? What what is the right say I know there is probably not one rule around it, but what are those one or two or three or top three options for the first time fund structuring that we are looking at?
I would say it's a rule called the KISS rule, which I was trained when I was a little, again, a very young attorney. Keep it simple, stupid. That's the KISS rule. And it's true. Most firms that you're building are going to fit a simple paradigm of a structure. I don't know if I could share a screen. I could even pull up the structure chart if viewers be able to see that. In designing an investment management firm, a venture capital firm, a private equity firm, what have you, the structure chart that you're seeing here is to me the elemental and 9 times out of 10 optimal structure. Your question was an interesting one, Rakesh. In terms of let's talk about how to design a first time fund, and then let's talk about how bigger funds, how more institutional funds may be structured differently. And what I would interestingly probably say to that is 9 times out of 10 they're the same.
Hmm.
In other words, larger funds don't tend to become more complicated in structure. There may be and there are deviations from what I just said. If you have a lot of investors coming from Europe and a lot of investors coming from Asia and a lot of different types of investors coming from different global, jurisdictions, there may be tax reasons and other reasons why investors would be comfortable with different types of entities to come into. So you may have a Luxembourg entity and a Irish entity and different things for different types of investors. But most of the time, especially unless you're raising like some mega $10 billion private equity fund, if you're raising a $500 million middle market, lower middle market PE fund or a $200 million venture fund, the structure chart you're looking at is 9 times out of 10, maybe 9.9 times out of 10, going to be the starting point and the correct endpoint. The big picture is the fund starting at the bottom of the page. It's a Delaware limited partnership. Sometimes clients come with preconceived misconceptions, I would say. Um, well, I'm going to take some money from Europe, so I need an offshore feeder. No, KISS. Keep it simple. Keep it simple. 9 times out of 10, that's not necessary. It doesn't give you anything. It doesn't benefit the investors and just adds cost and complexity to the structure. Non-US people can come into a Delaware limited partnership.
Yeah.
Okay. Um, that's at the bottom. Um, that's the fund. No parallel funds for the most part. Again, we can double click why a parallel fund may be helpful. No feeder funds. We could double click why a feeder fund may be helpful. But 9 times out of 10, it's a single Delaware limited partnership. And now we're thinking, okay, we built the fund design wise. What about the firm? What about the entities that the founder and his or her partners are going to be forming to manage and own Fund One and future funds? And that's where these other three triangles come in that you see here. I call this the diamond structure for obvious
Yeah.
reasons. So the fund is at the bottom, and that's where the limited partners invest directly. But then you have a general partner up to the right. That's the entity that will manage the fund technically under Delaware law and also receive the carried interest, the profit share on investor dollars. That's unique to this particular fund. So fund one has GP1. Fund two has GP2. Sometimes clients come and they want to cross their GP across different funds. And I advise them against it because the GP is the entity that, at least technically in Delaware, holds the residual liability for the fund. The general partner of a limited partnership, the fund being a limited partnership, the general partner, meaning this entity, does not have the benefit like the limited partners, like the investors do, of having limited liability. So we don't want to ever cross revenues and liabilities from different funds into one entity if we can avoid it.
Makes
On
sense.
the other side of the page here, we have the management company. That is constant. That will survive Fund One and manage all of your funds. That's the entity that has the management fees running to it. That's the entity that has the expenses, so overhead, employee, office, supplies, all that stuff is an expense of the management company. That's why the management company, the management fee goes to that entity.
Correct.
Then I have some clients who say, wait a second, why can't we just merge the GP and the management company? Why can't I have management fees and carry go to the same entity? And I harken back to the same reason why we don't even want one entity to be the GP of more than one fund for liability purpose, limited liability protections. You certainly in spades don't want one entity, your going concern, to also have the residual liability as a general partner of a fund. That's one reason. And then our tax colleagues will also warn you that for all sorts of reasons, which are probably beyond my ability to explain succinctly or in depth, why you also really want to be careful not to cross your fees, your management fees, with your profits interest, with your carried interest, for state and even city specific tax reasons. New York, Chicago, San Francisco, a lot of the big cities where a lot of the GPs live and operate, they have taxes which hit the management fees, but would not hit the carried interest unless you make the mistake of bundling these revenue streams within one entity. And then the tax that would only have hit the management fee, voila, now that also can infect your carried interest. So different reasons why we want to be careful in setting up the firm. Number one, each fund has its own GP. Number two, don't cross management fees and carried interest in the same entity. That, if we stop there, we've described the bottom three pieces of this diamond. What's the top piece? The top piece we call the UGP. That stands for the ultimate general partner. You could also call it the GPGP because it's the GP of the GP. What entity type is the fund? We already said it's a Delaware limited partnership 9 times out of 10. What entity type is the GP of a fund? What entity type is the management company of the fund? Here you see two main approaches. Some form those two entities, the GP and the management company, as LLCs. It's not wrong, but it's also not ideal. And there's no upside, in my view, to doing that. What we recommend and what you see in this structure chart is both the GP and the ManCo are, like the fund, Delaware limited partnerships.
Makes sense.
There's different reasons for both the GP and the ManCo why limited partnerships may be better from a tax perspective than LLCs. Certainly no worse. So if I ask you, if there's no upside to an LLC, but there's potential upside to a limited partnership, if not in Fund 1, then in Fund 2, which would you choose to form your entity as? A limited partnership. There's only potential upside. It's not necessarily upside, but it's potential upside, and we can get into it or not. That's what we recommend. So if we stop here, you have 3 Delaware limited partnerships. By the way, small digression. Why Delaware? I'm in California. Why am I always talking about Delaware? Because Delaware courts are the best. They have the best judges, the most knowledgeable, and because Delaware law is tried and true and tested through decades of disputes. Um, they are just the best tested and most matured jurisdiction, both in terms of settling disputes and interpreting law.
Yeah.
That's why you see, everyone form in Delaware. And another thing is the Delaware legislature, in drafting the LLC and the Limited Partnership Act, they are very deferential to the parties to the transactions. So they really don't. It's not a nanny state like California, for example, where the legislature says, "Look, I have to protect the parties to the contract that they're entering into. So I'm going to, by law, impose, let's say, consent rights, that the LPs need to consent to things that the GP is wanting to do." Delaware law is essentially telling you, I know this is a little bit of a tangent, but Delaware law just is set up like this. It says, here are all the default rules. Feel free to contract around them. To the extent your contract is silent, we're going to fill in the holes with the law. As opposed to a lot of other jurisdictions where they're like telling you what your contract needs to say, and even overriding your contract, unless you're very careful to draft around it. So that's a little digression why I keep mentioning Delaware, Delaware, Delaware. And we'll see. I know there's a movement afoot. I just got back from Dallas. I know there's a movement afoot in Texas to maybe compete with Delaware, right? To have special courts set up that really are very business minded and knowledgeable. And so we'll see how that goes. It wouldn't be a bad thing. So right now we have 3 Delaware limited partnerships. Then we move to the top of the pinnacle, the apex of this structure. That's the UGP, the ultimate general partner. That's where I succumb and I say, okay, an LLC is okay there. That's fine as an LLC. There is no money coming through that entity. That's a control entity. That's the brain center, if you will. That's the entity that serves as its name implies, the ultimate general partner. It controls as the GP. It controls the GP of the fund. When you form Fund 2, that UGP will be the GP of the GP of Fund 2. When you form Fund 3, that UGP, that ultimate general partner, will be the general partner of Fund 3, and so on. And it also, if you look to the left side of the chart, of the structure chart, that UGP is also the general partner of the management company. So again, dollars don't flow down or up through it typically, not necessary. You can keep that as a very simple LLC agreement. It really doesn't require bells or whistles for the most part because money is not involved in terms of flowing up or down, but it just decides things on behalf of the whole structure.
Well, this is very helpful, Yoni. I'm glad that we brought this up as a visual because I think that's put things in context. But just to add a little bit to this, again from the perspective of a new manager coming in, what is the flow of money both ways when you are uh, doing the investments or the calls, and when you are distributing it back to the investors?
Yeah, so the LP's money, the investors' money, all is relegated to that LP line at the bottom of the chart here. So the LP contributions, the limited partner capital contributions, just follow this line into the fund, and the fund deploys that into these portfolio investments, makes profit, and then kicks out the profit. The return of capital, and if there's a preferred return, and then the profit on the capital back out to the limited partners. So that is very, very straightforward. And then the other part of the question, I think, is how does a GP's money come in? And has a GP earn its share of the profit?
Even Manco's money, for that matter.
And I'm glad you said that because I would not even expect Manco to put any money into a fund. The management company is not an investor. The management company is a business. It has operations, it receives fees, management fees, and it pays expenses. If there's anything left over, in the early days of a firm, there won't be any left over, right? It's a capital intensive endeavor, and there's not a ton of fees coming in a fund 1, right? But over time there will be net management fees, excess management fees that remain after expenses are paid and reserves and all of that. Those excess management fees would follow this line, net management fees. It would go back up the chart. So again, management fee comes from the fund up to the management company, paid expenses from there, and then any excess that's not reinvested into the, kept in the manco would then be kicked out to the limited partners of the management company. Who are the limited partners of a management company? 9 times out of 10, the same people who own the UGP, the founders of the firm. They control the firm through the UGP. They get their management fees from their interest in the management company. What about the other half of the economics? Well, it's the other component of economics. Hopefully, it's not half of the quantum of economics. Hopefully, it's a lot more than half. That's the carried interest. So LPs put money into a fund. The fund makes investments. The investments do very well. In the meantime, while the investments were being made and doing well, the fund was also calling capital from the investors to pay this management fee to the management company, which is then using that management fee to pay expenses. When these investments do well, as we said a minute ago, the fund will distribute the proceeds of those exits or investments to the limited partners, depending on the distribution waterfall of the fund. Rakesh, we're going to spend an hour talking about distribution waterfall for another time. We're going to talk a lot about that. That's where it really gets fun. Let's say a simple venture capital waterfall. You return investor dollars and 80-20 split, as simple as you can get. So LP invests $100. The $100 is now $200. What happens? $200 is sitting over here in the fund. $100 goes out to the LP to pay back its capital. Now there's $100 of profit. How is that distributed? Simple case, 80-20. $80 goes back to the LP. So the LP put $100 in. Now it's $180 back. What about that $20 profit on the LP's $100? That goes up to the GP. So again, $100 comes over here from the LP. Let's say one investor, general partner turned in the fund, turns that into $200. They have $200 to distribute. The LP gets 180 of those 200, and the other $20 goes up here, not here. We don't want to cross the fees with the carry. This is the carry now we're talking about. This $20 goes up to the GP. Where does it go from there? Doesn't go up to the UGP 9 times out of 10. It goes up to the limited partners of the GP. Who are they? You guessed it. They are the founders of the firm. But they're probably not the only limited partners of the GP. They probably are the only limited partners of the Manco, because the management company is not something that you're really expanding ownership of across a team. But the general partner, 9 times out of 10, I know I keep saying that, but it's the truth. There are patterns here. 9 times out of 10, the founders of the firm who own the UGP own the LP interest in the Manco and own the lion's share, but not all, of the limited partnership interests in the GP of the fund. They also have a team around them. They have advisors. They have employees, investment professionals that need to be incentivized. People are not in this for a salary alone. They're in this for the upside of the carried interest. This $20 in our example that was paid from the fund to the GP needs to be shared among the team. So people are incentivized to source and execute and manage and exit great deals. Those teammates, even if they're not principals of the firm, they're not owners of the firm, they will be admitted as limited partners or something like limited partners, if it's called something else, economic interest holders into the GP of that fund. And they'll get their percentage of carry directly here. So that's why you see the green arrow, if you trace it, carried interest goes from the fund, this $20 in our example, goes from the fund to the GP. And then from the GP, it's split in 2 ways potentially. It goes to the founders of the firm who are limited partners of the GP, and it goes to any other carry recipients, team members, advisors, investors, investment professionals, employees who are going to get a share of the carry. That's all how the money comes out of the fund and how the money from the investors come into the fund. How does the money from the GP come into the fund? Again, the management company is not putting any money into a fund. That's just a business. That's just an overhead center with fees to pay expenses. But you're quite right, Rakesh. These investors down here are not going to be excited to put a bunch of money into a fund unless they know that these guys up here, the guys who are forming the fund and selling it to the investors, investors want to see that the GPs, that the owners of the firm are putting their money where their mouth is.
Yeah.
You think this is a great investment? How much are you putting in? Well, I'm going to get 20% of the upside. No, 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 no. That means you have nothing to lose. That's just upside. What do you have to lose? What's your skin in the game? Right? And so they will require, not as a legal requirement, but as a market business requirement. I'm not putting in $99 into this fund unless you, the GP, put $1 in as a minimum. 1%, anywhere from 1 to 5%, I would say is market. Very often for an emerging manager, and I get this question very often, even 1% is fine. Don't feel like you're a cheapskate if you're putting 1% of the fund in on your own part. That's very routine, especially for an emerging manager. Everyone knows you're doing this because you're going to build an empire. You may not have built it yet, and you probably haven't. So cash flows may be tight, and to put in 1% of a $100 million fund is still $1 million. Now you're not putting it in one shot; it's going to be over years. And we're going to talk, Rakesh, about different ways to do this in a very tax efficient way. But let's just assume the GP or the principals are putting 1% of the fund in. Let's call that $1 million. How does that come in? How does that come in? There's different ways to get it in. Should we double click on that? It's a whole conversation. I don't want to. I'll let you lead because we're getting deep
No,
into
I
this.
think it's interesting, and while it's still tied into the conversation that we are having today itself, maybe a high level overview of that would be helpful because I know when we get into the details of it, it can be a full conversation and an episode by itself. But maybe a high level touch upon it would be helpful.
Yeah. So these are essentially the two ways that money can come from this bubble up here from the GPs. I say GPs colloquially. They're not actually the GPs. This entity is the GP. These guys are the
Hmm.
principals, the founders, whatever you want to call them, the owners of the firm. They're not actually GPs, although I know a lot of times people refer to themselves as GPs. You actually don't want to call yourself a GP as an aside for the reason that we said earlier that you don't want to cross GP entities across funds. GPs technically have unlimited liability. Please don't call yourself a general partner. You're asking for unlimited liability, right? Call yourself a founder, co-founder, managing partner is okay. How did I digress. How did these folks get their money into the fund? Let's say they're 1%. They could either put it like this, follow this line. Down, reverse this green arrow. They could put money into the GP, which puts money into the fund. Okay,
Yeah.
that's very routine. The other way they could do it is there's no line here. Just follow my mouse here if you can. Woo! They bypass the whole structure. They just put money as limited partners straight here. The principals jump down here. They're limited partners, and they put money in as limited partners. That's another way to do it. There's And then you can combine them, right? You can combine them. You could put some money in as a limited partner. You can put money in through the GP. And you're right, we'll have another conversation where we talk about all sorts of nifty, tax advantageous and more complex ways of funding your GP commitment.
Yeah.
Um, I would say if you're putting money in through the GP, keep this in mind. This entity, the GP entity, has now at least two revenue streams coming into it, right? What are they? The carried interest, that $20 we talked about a few minutes ago. That's not $20 earned on the GP's money. That's the GP's share of the profits earned on the investor's money. But then there's also a different revenue stream. To the extent the GP actually puts money into the fund, let's say that 1% of the fund is coming through the GP, that $1, that $1 million, that 1% of the fund, like the investor's money, that's also going to generate profits. So the $1 million that the GP entity put into the fund is now worth $2 million. The same way the LP's $100 is $200. Let's not talk about millions. Let's talk simple numbers. The LP put in $100 in our example earlier, which now is $200. That means if the GP put in $1, the GP's $1 is now worth $2. That $2 that's sitting in the fund is distributed to the GP. And from there, that $2 is shared among the limited partners of the GP who put that $1 into the GP and then into the fund, right? So all I'm pointing out is when you structure and document your GP entity, there's not one waterfall of this is the metric how dollars go out. It's based on your percentage ownership of the firm. No, it's got to be more nuanced than that because 9 times out of 10, I know I keep saying that, the people who are putting in the money into the GP for investment into the fund are not the same as the people who are sharing in the carried interest from the fund.
Correct.
It's usually going to be a broader group who shares the carry because it's the founders of the firm plus some advisors and employees and others, right, who are helping them. All of those people are typically not investing into the fund through the GP. It's typically the founders who are putting the money in. So they have to be able to share just themselves in that $2 that their $1 turned into. The other $20 on the investor's investment in the fund, that's the GP entity's share of the investor's profit, that can be more broadly shared within the GP among the larger team. So two different economic ownership metrics of a GP. We call them, not surprisingly, the carry percentages, more disparately and diversely shared among a team, and the capital percentages, which are most typically owned by a subset of those who are receiving the carried interest, usually just the founders
So
or the owners
are
of the
there
firm.
ever any times when the founders are bypassing the general partnership and putting the money directly as a GP?
Yes, yes.
What
And
are
it's
those
mainly
scenarios?
so different. It comes down to tax. And our tax folks recommend that some of the money, doesn't have to be all of it. The magic number is 0.2%. Okay, 0.2% of the fund, or said differently, if the GP is writ large putting 1% of the fund's capital in, 20% of that 1% should come in directly from the GP into the fund. The other 80% of that 1%, the other 0.8% of the total fund can bypass the GP if they'd like.
Makes sense.
That's strictly a
And
tax.
would that tax be dependent on where the individuals are residing? Is it dependent on the state tax laws, or is there something else
No,
which decides
no,
that?
it's to buttress and make strong is the argument that the $20 profit share in our example that's being paid to the GP is not compensation, but it's actually an investment return. It's hard
Right.
to argue that that's an investment return if you haven't put any money into the fund. So the argument is as long as you put 0.2%, and I can't tell you where that 0.2 comes from, it comes from somewhere. Um, as long as this entity is putting in 0.2% of the total capital in the fund, it strengthens the argument, which is always talked about, is talked about even now. We put out a client alert about this just the other day that the Trump administration is talking like every administration has over the past, I don't know, since I've been doing this 20 years to change the taxation of carried interest to ordinary income versus capital
Capital
gains.
gains. Yeah.
Um, to maintain the strongest possible argument that that carried interest should be capital gains and not ordinary income, you want to have some money, some investable dollars coming in from the GP into the fund. So that's where that comes. But for that argument, I think folks a lot of times would just put money in directly as limited partners. But once you're putting in 0.2% of the fund through the GP, again, to strengthen the argument that the carried interest is capital gains and not income. Once you're putting in $1, you may as well put in all your dollar, right? Once you're putting in 0.2%, you may as well put the whole 1% through the GP. The GP agreement already has the infrastructure to deal with the 20 cents coming in. You could also put the whole dollar in. So that's why you don't usually do both in the same fund.
Now that there's some clarity on the kind of structure that we can expect, and you already answered some of the points that I wanted to bring up around the jurisdiction and the reason to choose a jurisdiction, whether it's tax or whether it's CLPs or whatever it is. So what is it that founders should do so that they are ready enough to go through this process fast and smooth?
This is a great point about the cadence and the process of an emerging manager forming the firm. And I break it up into three steps. Okay. Step one is design. Step two is build or construct. Step three is close. Design, phase one. Take these blueprints, the structure chart that we're looking at, that's tailored for you. A summary of terms. Mine is about 14 pages long. It's detailed. Your deck, your marketing deck. Bring those three easy to assemble, inexpensive to assemble documents and market and canvas and have meetings.
So you
Then,
say no filing done until then?
no, nothing. No filings, no entities, no documents. Keep it simple.
Hmm.
Structure chart, summary of terms, marketing deck. Go market your fund on these three things. Then it could be a week later after we design the fund. It could be 6 months later. When you have LPs who say, "Hey, Rakesh, I get the structure. I'm fine with it. I like the terms writ large in a summary format. Let me see the documents. Let me see the partnership agreement, all that stuff." Then you come back to your lawyer like, "Okay, we're ready to progress from phase one to phase two, from design to build, construct. Now we can form entities. Now we can put the partnership agreement together. Now we can put a subscription booklet together with some sort of disclosure document, management agreement to contract between the manco and the fund, all and a bunch of other stuff." But I mentioned the key pieces that you only commence when you have investors who are ready to review it. Otherwise, you're getting ahead of your skis 9 times out of 10. Um, and then you're in phase three. Once you've opened your data room with your phase two built and constructed documents, now you're in phase three. Phase three is closed. Now it's a waiting game. Now we've given away the power to control the clock. Now the power to control the clock is in the investor's hands, right? They have to review, they have to negotiate if they are going to negotiate, they have to sign. And once we've gotten them across that hurdle, then we countersign and send out a beautiful email. "Congratulations, the fund is closed. You're now a limited partner. Capital calls will be coming soon." That's phase three.
No, this absolutely makes sense. I think this is very beautifully put, and I sincerely appreciate, and pretty sure everybody else will sincerely appreciate how simply you have put it across. KISS, as you rightly said, right? And again, as I said, we'll further get on to the things. I have zillion questions like our audience would have. What happens if I start investing? Where do we put the warehousing stuff? How does that come into the share? Where do we factor that when we are putting the structure together and so on? But again, I think we have to get to the next time for all those conversations. This actually, I'm so glad this actually came out more like a masterclass than just a simple another podcast. And I so appreciate you doing that for us, Yoni.
I'm thrilled to be here, Rakesh. And I couldn't be happier to have these conversations with you and the audience. And I'm excited. When's good for you? Tomorrow morning? Should we do the next one? When's good for you? You tell me. I'll be there.
As I said, Yoni, this is such a great conversation that we had. The way it has been put together, the simplicity that you have brought into the conversation, the value that I'm pretty sure our audience will get out of this, and I'm very sure, like me, most of those who will be listening to this podcast would be looking forward to our subsequent conversations on so many other things. So, thank you again. Appreciate your time, and we'll talk soon.
I'm looking forward to it. Thank you, Rakesh.